So, are you thinking of moving to Burlington, Ontario? In this video, we're actually going to talk about something completely different. How about discussing three major differences in the real estate between Canada and US? Let's get started. I'm Milena, and I'm a local real estate agent here in Burlington. The good news is that our team drops content every week about how is it to live in the Halton region and the whole GTA area. If this is your first time on our channel and you want to know everything about living in Burlington, Oakville, Milton, the whole region here, and the GTA area, subscribe below, tap the bell for notification, and you're going to be the first one to know about the current market. We help people just like you all the time, so it doesn't matter if you're moving in a week, a month, or a year. Feel free to reach out. Our information is in the description box below. We will be very happy to help you find the right place for yourself. You can reach us via email, phone call, text, Zoom, whatever works for you. We're here for you. So are you curious what we're going to talk about today, about these three major differences? The very first one is mortgage terms. Canadian mortgages often have 25 years amortization and require refinancing 3 to 5 years. The closing cost is usually between 1.5 and 4% of the purchase price. If you want to pay your mortgage earlier, you need to read the mortgage terms, because there might be penalties that prevent that, or it might be costly. Here how it plays in Canada when you have to refinance. So the pandemic was an excellent example. The rates were very low, lots of people bought houses, their monthly payments were very reasonable. Well, 3 years later they had to refinance, and what happens now is that the rates are much higher, which means the monthly payments are higher than the ones that they originally closed their mortgage on. In the US, the mortgages are different. They usually last about 30 years with fixed rate. There are options for shorter term mortgages like 10 to 15 years. The rates are a little bit higher. The closing cost is usually 3 to 5% of the purchase price, and you pay it every time when you decide to refinance your mortgage. I'll give you an example. In 2008, when the economic conditions changed in the US, we decided to refinance our house like many others. Our original mortgage term was 30 years, or let's say 5.5%. We decided to go for 15 years for much lower rates. So let's say we used to pay $1,500 a month for 30 years. Well, after the refinancing, we were still paying the same amount, but for 15 years. That's the benefits of fixed rate. Just keep in mind, every time we need to close our mortgage, we need to also include the closing costs. Additionally, there is one more benefit in the US when you want to shorten your term. You can make small monthly payments, let's say $25 a month. This is just an example, on the top of your mortgage, and you're gonna shorten your term for, let's say, 5 years, sometimes even more. It just depends how much you pay per month extra. The bank gives you the breakdown, and at the end you can see how many years you have left on a mortgage, and this is done without penalties. Now you can see how in Canada, if you want to pay off your mortgage faster, might be costly, where in the US, the banking system is much more flexible. Number 2, primary residence capital gain exemption. Oh, that's long. In Canada, in order to qualify for this exemption, you must live in your home for 12 months before you sell it. And then you keep the profits tax-free. But of course, you need to qualify for the exemption. In the US, it's a little bit different. You need to keep your house and live there as a primary residence for at least 2 years before you sell it. And guess what happens after? If you're a single person your capital gain exemption is $250,000, and for couples, $500,000. What does it mean? Let's say I buy a house in the US for $100,000 this year. 2 years from now, I decide to sell it for $500,000, and I am by myself. I made a profit of $400,000. That means that I can apply for the exemption up to $250,000, and the rest of it is taxable. Let's say I'm married and we buy our home today for $100,000. 2 years from now, we decide to sell it for $500,000. The profit is $400,000. Since we are a couple and we can file for an exemption up to $500,000, we don't have to pay taxes on the profit. Number 3, capital gains inclusion rate, which was changed recently in Canada this year in June 25th, 2024. And this is how it works. 50% of the first $250,000 of capital gains that you acquire in a year must be included in your income. And for any capital gains above this amount, 2/3 is included as income, which means that any property that is not considered your primary residence is subject to capital gains. So let's do that. You buy an investment property today. Property appreciates in value, so you get a good deal. Somebody offers you much higher price. You sell it. When this happens, on the year of the sale, the capital gains that you received, part of it will be added to your income of this year, and you will be taxed on it. In the US, it's different in terms that if you want to buy an investment property and sell it within a year, which a lot of people do that for fast cash, then that profit that you made that same year where you bought and sell the house will be combined with your ordinary income. What about keeping the investment property for longer than a year? Now, you're going to be taxed at much lower rate, meaning long-term capital gains rate can range between 0 to 20% depending on the income. And it's gonna give you much more favorable terms in order to keep your investments longer. Can Canadians buy properties in US? Yes, you can. All you need to do is transfer your Canadian credit score, then apply for what calls cross-border mortgage. This is if you want to finance, of course. They're gonna require the same documents that you submit here in Canada. And don't forget that you need to put at least 20% down payment. What about US citizens buying properties in Canada? Can they do that? Yes, they can. They can apply for the same mortgage as a non-resident, which has a higher rate usually. Then put at least 35% down payment. Also, you guys can transfer partially your credit score from US to Canada, and then of course supply all the documents that are needed for mortgages that are usually asked in both places. If you're a non-resident and you want to purchase a property in Canada, in this case, you need to add the non-resident stipulation tax and the land transfer tax to the purchase price. Keep in mind that they are different in different provinces. For instance, the non-resident stipulation tax in Ontario is 25%. Thank you so much for staying with me throughout the video. It was really fun to tell you the differences between US and Canada. I used to live in the States for a very long time, and now we moved here. So I can tell you the differences firsthand. And if you need to find a place here or there, feel free to reach out. My information is in the description box below. You can reach me via email, phone call, Zoom, text, whatever suits you. I'm here for you, and I would love to help you find the right place or the right investment. You have a great day, and I will see you on the next video.